by, banks are in a better position to shed assets. Every quarter that goes by, banks can continue to earn money. They can continue to mark down the assets. They can continue to move them off their balance sheet. I think it has much to do with low interest rates, being able to mark down assets as it does with pressure.
Okay. Paul?
We are seeing a marked increase right now of a lot of assets starting to hit the market, and it's made up really of, I'd say, 4 categories. Banks are starting to focus on their commercial portfolio. They were dealing a lot with their residential portfolio and other things, but I think that's number 1. So a lot of banks, we're seeing more of that. The special servicers have worked through now a year to 2 years of distress, and they believe a lot of those assets are now priced. The market has come back, and they want to move those off their balance sheets. 3, the people who didn't sell before things happened, individual owners, older owners, are now rebalancing their portfolios. And 4, people who do believe that the market's gotten ahead of itself are also, we believe, starting to pare their portfolios some and starting to sell. So that is increasing the asset flow by probably 2 to 3 times, we think, 2011 over 2010, at least in our asset classes. And I think that will continue. The question's going to be whether, as that moves along, if fundamentals don't get a lot better quickly, whether that will lead to more of a flood because people are worried that prices might go down.
Okay. Jeff?
Yeah, I would agree with pretty much everything Paul said. We too have seen a pretty marked increase in our deal flow, I'd say, over the last 4 or 5 months. It's a little bit difficult for me to put my finger on exactly what's driving it. My sense is that the price of paper, the price of property is clearly sort of started to rebound, and I think that you might have a situation where the price of distressed paper is now sort of converging with where these assets are marked on the balance sheets of banks. And that gives banks the cover to go ahead and take things off their balance sheet without having to incur further losses on the trade. I think also that I think there's a lot more loans are just hitting their hard maturity dates, and you have a lot of over-leveraged properties. There's a lot of legacy asset issues. There's a lot of borrowers out there, whether it's an opportunity fund or even an individual, that just lack the liquidity or the capital commitments in their fund to kind of go ahead and reinvest in legacy assets. It's hard to bring in other capital, from Fund 2 into Fund 1. There's a lot of conflicts with that. Some assets are close enough to, sort of being worth the debt where you can go out and attract a third party, but, that's not that easy either. So, I think that there's just more, because there's more maturities, more people are just kind of throwing up their hands, and banks are just willing, they don't want that on their balance sheet, so it's coming to market. So I think, in my view at least, that's kind of what's driving things.
Okay. Claudia?
Well, I think from the bank side, there are a couple things going on. Banks are regulated such that we can't be long-term holders of REO. So, if we took back property in sort of the early part of the cycle, once you get to about 24 months, there's really pressure on the banks in general to dispose of that REO. So you're seeing some of that from sort of the early stage. A lot of banks have had pretty good experiences restructuring deals and selling notes, and so their distressed portfolio has reduced at a fairly good pace, and so they're sort of looking at that profit center again now and saying we have to start to put on new business to make money again, at least as the real estate unit. And I think as the rest of the overall banks are making money, they're focusing on the new business side again. And from an REO sales standpoint, the numbers do demonstrate that there's really been an increase. I think in the fourth quarter of 2010, banks sold about $4 billion of REO as compared to about $1 billion in the fourth quarter of the year before. And I think also from a special servicer standpoint, distressed transactions have really accelerated.
Right. Claudia, you mentioned earlier that the regulatory environment is different this time around for banks in terms of what they can do in terms of making loan modifications, restructurings. Any further thoughts on that?
Well, having been through this in the last cycle, when we were originally entered the workout phase in the early 90s, the whole concept of a troubled debt restructure, TDR, didn't even exist. And so back then there were a lot of deals that were labeled performing non-performings, which were deals that were really adversely rated simply because of a loan-to-value issue, which was really just a market issue. And so in this cycle, with the advent of this TDR structure, there's an ability to restructure a loan looking at more than just the market impact and the valuation impact. So in order to do that, you can look at both the borrower distress in a much more broader sense. So it's not just, has the value gone down? It's, what's the cash flow of the asset look like? What does the cash flow of the sponsor or the guarantor look like in their overall portfolio? And so simply from an A-note structure standpoint, you're able to create an A-note that has a much higher loan-to-value than it did in the last cycle, which is directly tied to what a bank is going to have to write off.
And maybe for our attendees here, A-note, B-note, do you want to try to define those for us?
These guys keep wanting me to define this very succinctly, but
This is my job.
I know. I mean, the good news is there's no easy and straightforward formula. So for the owners, there's much more flexibility for an institution to restructure a deal and to create an A-note. The A-note being really what the bank or the financial institution is trying to get back on the performing side of their balance sheet, meaning they have to set aside, far less in a reserve for that particular asset. And so this time around, you could have an A-note that could be 85%, 90% loan to value if the debt service coverage on that A-note is something, that's above 1.0. And so that again gives you the ability to have more flexibility on the restructure. And then whether a deal has a B and or a C note depends on again what the loan outstanding amount is relative to the overall value, relative to the cash flow that might actually be present at the time you're restructuring the deal, or the cash flow that might potentially be coming in, or the ability of the sponsor to put in additional equity to support the transaction.
All right, Paul, you had a cynical smirk on your face. Why don't I take you next?
Well, my smirk was for two reasons. One is we have tried to get into a number of transactions. We're in our own transactions, but that were with special servicers, where everybody thought there was going to be a lot of brand new A-note, B-note work, and the answer was you'd never get there. I don't think, Jeff, maybe you'll be aware of one or two deals that happened, but almost no deals happened, and it was more of a nightmare, and great for the lawyers and not good for anybody else when you got there. Obviously, in the bank scenario, it works. We have seen it, and we have seen it used to basically just kick the can down the road. I can tell you of a deal. I had a conversation with somebody about a deal. This was a resi deal. It was performing basically it was returning about 3% on cost. And at the time, let's say it was worth a 6. So, but it had coverage because it was a LIBOR plus. And I asked the bank, I said, so why aren't you going to sell this thing? And they said, well, we haven't marked it down. And I said, well, why haven't you marked it down? They said, well, it's a performing loan.
Right.
They're paying it 125 bips over LIBOR. It's fully performing. And I said, well, yeah, but what is it worth? I said, well, we understand that it's worth half of what the loan is. But as long as we keep it on the books that way and keep the LIBOR low, it's performing.
Right.
That's why I was smoking.
All right. Jeff?
Yeah, look, I haven't seen a lot of A/B structures getting done, in particular with special servicers. I mean, I'm sure there's been more than one, but I'm actually only aware of one. So that hasn't been a very fruitful strategy. But I would say that when you kind of step away from special servicers into the banks and some of the, kind of finance companies, if you will, we actually have had some success. We recently did one with a finance company that, doesn't mark to market their assets the same way that, a securities firm or a bank might. Definitely didn't want more equity on their balance sheet. So it was really important for them to keep the loan outstanding. And, we were looking, our loan was maturing. We wanted to extend it. The collateral, value really wasn't worth the, worth the debt amount. But they wanted some more equity to come into the deal, and we were willing to put more equity into the assets, but not at the, not subordinate to the current loan balance. So in that case, we split this loan into an A and a B structure, where, we put a new interest rate on the A note, call it 5%. We put in $10 million of new equity at a basis that, we felt was very protected based on the current value of the assets. And we subordinated a B note and our legacy equity to that. I think what's in it for us is that we have 5 years of additional loan term. We're going to get all of our new money back with a 20 before the B note's going to get any of its principal back. There's no interest rate on the B note, so it's just kind of all quasi-equity, if you will. And then we're going to have a back-end split on the ultimate recovery of the portfolio. And we think the portfolio will recover. These are very high-quality assets. They're in high barrier-to-entry markets, and as they lease up and rents begin to increase, we're going to do fine. So, I think it was a win-win. But in that particular case, there was some, bigger, sort of corporate-level issues that I think helped to get us where we need to be. I tell you, 9 times out of 10, you spend 6 months trying to figure out an A and a B structure, and you end up doing a DPO. That's basically how it works.
David?
So at the end, it ends up with somebody taking a haircut.
Yeah.
And that's what needs to happen.
Yeah.
And I think at some point somebody mentioned, maybe it was before this, kind of the haves and the have-nots. And it sounds to me, correct me if you disagree, guys, where you're going to have those assets where it makes sense to get really creative, bring in the lawyers, there's long-term value there, and then there's kind of everything else where, look, at the end of the day, debt is the new equity. Somebody has to take a haircut. That asset changes hands at a new basis with a new owner that now likes the asset. And I think really until that starts to happen on a wholesale basis, we're going to muddle along for a while.
Okay. In this sort of give-to-get world of debt modifications, are there any rules of thumb? Jeff, you just described a structure, putting your new equity in after that. Is there any, for the benefit of the audience, particularly if they're holding a distressed property, anything that they should be thinking about in terms of requirements on their end in order to get loan modifications?
I think it's very case by case, but I'd say in general, when you're a borrower and you're sitting down across from your special servicer or your banker, they want to see some new equity. I think the amount's negotiable. 10% is probably a popular request, and you kind of go from there.
10% of the outstanding loan
Yeah,
balance?
10% of the outstanding loan. I've heard that a few times. 5%. Whatever's meaningful. It kind of depends on the motivation of the bank. Do they really not want this asset back? Do they want to, kind of keep it outstanding, keep it performing? I think that it's tough to if you kind of dial back the clock a little bit, back in 2009, where it was probably a much more of an extend and pretend mentality, where it was no money down, just here's your 2-year extension, just go away for a couple years. That's over. I think lenders want something. They want to see commitment, and they want to structure it in a way that they think is going to help them as well as the borrower.
All right. Any other thoughts in terms of debt modifications?
I agree with what Jeff said. I think what an important distinction that I know we encountered a number of times is just giving us the cash flow from the property is not what a lot of financial institutions consider new equity. So there really needs to, because